Hello and welcome back to my channel. Today, Bitcoin investors pay very close attention because the market is no longer trending. It's deciding. After months of selling pressure, Bitcoin finally printed a panic drop toward the 60K area and then snapped back fast. Moves like that are not random. They usually mark the point where weak hands exit and stronger hands quietly begin positioning. Right now, price is hovering around 67K, and this zone is extremely important because it sits between fear and confidence. Above this area, buyers regain control. Below it, sellers prove the recovery was only temporary. To understand what happens next, you have to understand market psychology. During the downtrend, traders kept selling rallies because the trend was clearly bearish. But after a sharp liquidation wick, the kind we just saw, the behavior changes. Big players stop chasing price lower. Instead, they start testing demand. That's why the market is now moving sideways instead of continuing straight down. Sideways movement after a drop is not boredom. It is negotiation between accumulation and distribution. Now let's talk about the bullish scenario first. For Bitcoin to turn strong again, it doesn't need to jump immediately. It needs acceptance above resistance. The key level is the 70K zone. If price begins closing daily candles above that level, it signals buyers are confident enough to hold higher prices. That usually triggers a chain reaction. Short sellers exit, momentum traders enter, and sidelined investors feel safe to buy again. When all three happen together, the market expands quickly. In that situation, Bitcoin can move rapidly toward the 78K to 85K region because there is very little resistance between those areas. The move won't feel comfortable. It will feel fast, and most people will wait for a pullback that never comes. But now we discuss the dangerous scenario, and this is the one inexperienced investors ignore. If Bitcoin fails to reclaim 70K and instead breaks back below the 60K low, the recent recovery becomes a trap. The long lower wick you see on the chart would represent buyers who entered too early. When price returns there, those traders panic sell to protect capital, creating a liquidity cascade. Markets fall fastest when hope turns into fear. Under 60K, there is very thin support until the 52K, 48K region. That means price would not drift down slowly. It would drop aggressively, shaking out late buyers. So what should investors actually do here? The answer is patience, not prediction. This is not a good chasing zone because the reward to risk is unclear inside the range. Professionals wait for confirmation. Strength above 70K favors continuation higher. Weakness below 60K favors a deeper correction and better long-term entry later. The middle area is where most traders lose money because they act before the market reveals direction. The biggest mistake right now is emotional trading. After a drop, people want reassurance and buy early. After a rally, they fear missing out and buy late. Both behaviors feed large players' liquidity. Instead, think in probabilities. You are not trying to catch the exact bottom. You are trying to avoid the wrong side of the major move. Markets reward discipline more than bravery. So remember this clearly. Bitcoin is not trending today. It is preparing. A breakout above 70K signals expansion. A loss of 60K signals capitulation. And whichever side breaks first will likely move fast enough that hesitation becomes expensive. This is the type of market where waiting feels difficult, but reacting late costs more. Watch the levels, not the emotions, because the next move will likely define the next several weeks of the market.